I have a confession to make. I've become dividend curious. And I feel like it's a confession because maybe we should know better. Maybe we should know, based on information that's available to us, that dividends aren't a particularly unique and value-adding way of investing. That we could accomplish the same things by investing in other equities that are more poised for growth, or more poised for like long-term security, and that dividends don't add any unique value to our life besides just the warm, fuzzy feeling of a cash payout. But I can't help it. Who doesn't love getting a dividend? It's so fun to get that little alert on your phone where it says, hey, you just got a new dividend. You just got this cash deposited in your account. What do you want to do with it? It's like getting a miniature paycheck every week or every month or every quarter. And so my admission is that I've started a dividend portfolio. You want to see it? Also, let's talk about why maybe dividends are actually a bad idea. Because if you watch a video like the Ben Felix video where he talks about the irrelevance of dividends, it feels like maybe they're a waste of time. It feels like maybe dividends are just a way to attract us to that company when they really don't add any extra value to our life. So I'll show you my portfolio and then we'll talk about the irrelevance of dividends. I decided to use Robinhood for this because why not? I'm not using it really for anything else. Robinhood is a slippery slope and it makes it really easy to invest more and more. And so I initially had a few $100 in here. And since then, I've basically decided if I bring my lunch to work, then I'll take the money that I would have spent on lunch and buy some dividend stocks with it instead. It's my rationale, my human psychology trying to hack my own brain to say, this will be worth it. Let's go ahead and do this. But that is part of the game of investing well, is trying to figure out how you can trick yourself into investing more and more. The more we invest, the more we have, the more that grows, the more dividends we get paid, the more income we have, right? That seems like that's how it works. So here's what I'm investing in so far. Most of these I just have a single share of, but some of them I've got more. I've got AT&T, I've got Prospect Capital, Enterprise Products, Arbor Realty Trust, Altria, Medical Properties Trust, AG&C Investment, Annaly Capital, Rhythm Capital, Redwood Trust, SoFi Weekly Dividend ETF, the much loved and adored apparently JEPI, the JP Morgan Equity Premium Income, and finally Ares Commercial Real Estate. So if we go to my profile here in Robinhood, we can see what the actual breakdown is of what these stocks are and what they're giving me. So 86% of them are stocks, 14% are ETFs. And the overall sectors that are made up in this are largely finance. I mean, energy and water's a little bit, consumer goods, healthcare, a little bit of tech, but it's by and large finance because these are companies who are investing money in products or in projects being built, and because they're getting a return on that equity, they're paying it out in the form of a dividend to people like me. Let's look at how it's performed so far year to date. So far this year, not really even counting dividends because I have them set to reinvest, but by and large, this is just the actual price of these stocks going up. It's gone up a little over 5% so far this year, which is not terrible, but compared to other things I'm investing in, it's also not great because I have some that are up 8 or 9% year to date. So these aren't set to grow the same way that those are. But as we dividend curious people know, the point of a dividend portfolio isn't actually growth. I mean, I don't want it to plummet in value, but the point is that these pay income. And a lot of these things have really high dividend yields. I mean, 6, 7, 10, 12% yields. That seems really appealing. Why would I not want that? Well, as I've dug more and more into the world of dividends, and I'm just really figuring this out and trying to learn it myself, and I'll continue to figure it out over future videos, there's two big reasons why dividends are actually potentially a negative thing for us. The first one is the irrelevance of dividends in that they don't matter. They're not doing anything good for us. The second thing is the problem with taxes that are created by dividends. So let's go over dividend irrelevance first. The dividend irrelevance theory basically states that a dividend payment doesn't have any effect on a company's stock price. And at first that didn't make sense to me because I thought, well, if something's paying a high dividend, shouldn't that be more appealing to people? And if it's more appealing to people, more people are buying that stock, which means it should go up in price, right? More appealing, more demand, more people want to buy it, price goes up. Well, this theory disagrees with that because it's saying that dividends don't have any effect on a company's stock price because whenever a company pays out a cash payment from its profits to its shareholders, the stock price goes down by a corresponding amount. So they have this cash, they pay it out to us, and the stock price goes down by a similar amount. So it just evens itself out. Another part of that theory is that there's actually a problem with that because when a company ends up paying dividends to people and their shareholders are depending on those dividends or they're counting on them in some way, then the company feels an obligation to continue to pay those dividends. And so instead of using that cash to reinvest in their company and make it grow more, they have to pay this dividend out. And it can be double damaging to that company because if they feel so inclined to pay the dividend, sometimes they even take out debt and have interest on that debt to pay this dividend to people. So instead of it coming out of this surplus and this equity in this profit to go, oh, look, we have this money to pay out to people. Let's go ahead and say, thanks, shareholders. Here's a dividend. Here's some earnings for you. No, we're actually like under the gun. We can't afford this. We've got to take out a loan to pay this dividend out. I mean, that seems like that would really hurt the company's value. This is tricky because I think in some sense it does make sense. Like you go, oh, well, if that's what really happens with the price, if it's just a steady price and then all of a sudden they pay out a dividend and it lowers their price of their stock, which lowers the value of the company, then maybe we're just sort of treading water. We're not actually traveling anywhere. We're not getting anywhere. All we're doing is building up some cash and putting it back out, building up some cash and putting it back out. And maybe that's not the best thing for a company. But then there's also people who have a critical view of this theory because they say that, hey, if this company is so able to regularly pay out dividends, it means they're actually financially strong. And there's actually some companies out there that have been paying dividends and increasing their dividend for years and years and years. People love Coca-Cola and Pepsi and Walgreens Boots Alliance and all these others that are like the solid dividend payers that people can count on. And so for a company to run its business in such a way, it means that they're strong enough to be able to have that factored into their expenses, if you will. And so if a company is that strong and that reliable, then that can have a positive impact on their stock price. It can actually make them worth more because they're able to have this extra cash available to send out to people like us. This is also tricky because it's open to interpretation. Some of the verbiage in these things I'm reading are saying the belief in the dividend irrelevance theory. And I'm going, belief? Isn't this financial stuff? Isn't this provable? Can't you just track this by the numbers and prove whether or not it's literally happening or not, whether or not it has an impact on price and not? It seems like it should be more defined than that. But that's part of the challenge of the financial world is a lot of things are measurable and trackable and almost predictable in those ways, but human nature really isn't. What if we just intrinsically value things more because they're attractive to us, like an income producing stock? I like that more than one that doesn't produce an income, so I'm going to go in that direction so that thing gets worth more. Those kinds of things. So there's a gray area here as far as people who are really smart who support it and people who are really smart and don't support it. But part two of why dividends are apparently really not attractive is how they affect our taxes. So the potential problem with this is the fact that if I get paid dividend money, then that can count as income for me. And if you've watched my past videos, you know that for us, income is the worst possible kind of money we can receive in life because income is taxed the most out of anything. So if I'm already making income from my job, if I'm already making income from a side hustle, and then on top of that, I get some dividend income, that money's going to get hammered with taxes. So let's dive into this for a second too, because there's actually two different kinds of dividends, and depending on which one it is, we'll either get taxed a lot or taxed not very much at all. Qualified dividends and non-qualified dividends. The kind that we want are qualified dividends because they come with an awesome tax advantage. Unqualified dividends or ordinary ones are the problems. So here's the three things that make something a qualified dividend. Number one, it's paid by a U.S. corporation or a qualifying foreign entity. So for a lot of us, that's pretty easy. Number two, it's actually a dividend in the eyes of the IRS. So regardless of what you name it, if you're getting a premium from an insurance company, if you're getting an annual distribution from a credit union, if you're getting something from a co-op or a tax-exempt organization, things like that, they don't actually count as a dividend. And so that wouldn't qualify for these favorable tax rates. The third part of this rule is something that I hear people quote a lot, and it's like this funny sort of mixture of terms and dates, but the long and the short of it is, if you hold the stock for long enough, then it can become a qualified dividend. If you're just buying it and you try and get a dividend here and there and then you sell it again because you're not holding it for very long, you'll get taxed on it big time. And this is a general rule of investing. If you hold on to something for a long period of time, you get taxed less than if you hold on to it for a short period of time. That's like the difference between long-term capital gains and short-term capital gains. So what are the actual tax rates for these dividends? Well, they're awesome. So for 2023, if you're a single person, you can make up to $44,625 just from dividends and not get taxed on it. If you're married filing jointly, it's closer to $90,000. And even then, if you crest over that because you have so much money invested and you're getting so many dividends, the next tax bracket up from there after you filled up the bucket up to that point is only 15%. So let's say you make $100,000 as married filing jointly. It's really only that last $10,750 that gets taxed at 15% tax rate. So dividends are actually highly incentivized by the government for you to get because they're taxed so little. But the only surefire way for you to know whether or not you're getting taxed really good ways or really bad ways for your own dividends is by at the end of the year, whenever you start getting your tax forms in, you're probably going to get something called a 1099 div. So a 1099 comes from your investment company. The div part is specifically relating to dividends, and it should say on there whether or not these are qualified or unqualified dividends. that just goes into a box whenever you file your taxes, and it'll say unqualified dividends here, qualified dividends there, and depending on how that goes, you're going to get taxed a lot. Unqualified dividends are basically treated like ordinary income. Like if you got another $1,000 from your job, that's like the same thing as an unqualified dividend. Now, I don't think I'm going to be too afraid of this. Like, I'm not too worried about getting unqualified or qualified dividends, especially if I'm just kind of getting started doing this, because right now, maybe the first few I'm getting are unqualified. And then after I've held them for a few months or a year, then they'll become qualified dividends because, okay, even if I get taxed more, I'm still making more money. I'm still keeping the vast majority of that money, so I don't need to be too worried about taxes. It's not like they're going to take away all of the dividend. But if we're having to ask this question about taxes even now, are we wasting our time compared to normal non-dividend investing? Because let's say I have the same money in another taxable brokerage account in Robinhood, and it's the same amount of money is invested, that's $700+, but it's not getting me dividends, then there's really no question of me having to pay any taxes on it. Because if those stocks go up in value, yeah, I've got more equity, but I'm not going to have any kind of taxable event. There's no income happening. There's nothing to really report on my tax returns every year. So I don't even have to think about taxes. If along the way I'm having these unqualified dividends happen that count as ordinary income, then I get taxed on those, then overall my actual net returns, despite whatever the app shows me, will be less because I'm having to pay taxes on them. So, as far as dividends go, is that enough of a problem for us to avoid them? The fact that they may not actually be as attractive as they seem because they make the stock price go down, the fact that we may encounter more taxes on them because of them being unqualified for a while, or depending on how you invest, maybe all the time they're unqualified, so they're basically earned income for you. That could be a problem. Is all that enough for us to say we shouldn't even do this? It's a waste of time. Don't even do dividend investing. Forget about it. I mean, it's up to you. For me, I remain dividend curious. And so I want this video to be sort of the first in an ongoing series of my dividend curiosity and how this portfolio does. I've got a big watch list down here at the bottom. If I scroll down and show you my potential dividend income list, I've got a bunch more that I haven't invested in at all. And so I'm curious to know as I go ahead and invest more and more in this, because I'm bringing my lunch, I'm not spending that money on food, I'm going to buy dividend stocks instead, what that'll look like overall. Because my fear is that in doing this, I actually end up stock picking, and I actually end up with a portfolio that's not very diverse like the one I have now. It's a lot of finance companies, which means that whenever something happens in the future that challenges finance companies for whatever reason, could be interest rates continuing to go up, could be some new regulation that makes dividends difficult to pay out for a finance company, could be whatever, maybe I'm going to get clobbered because I'm actually not very diverse and I'm so much into a finance company. That could be a problem. I may need to find other kinds of dividend-paying investments that aren't finance-based companies, because right now I'm way overexposed in that one area. But you're probably yelling at your screen right now going, Brendan, what are you doing? You've just laid out all these reasons why this could be a problem for us, why you're overexposed in that one kind of category of businesses. Why would you go ahead and do this if you know that this is a problem for you? Well, I'm at this weird kind of stage in investing life where we've been investing now for over a decade. We've got a good chunk of money invested there, but we don't have enough to retire on. We don't have enough for it to amount to anything for us as far as changing our life at this point. We're in this sort of dead zone in the middle of investing where you go, oh yeah, I've gotten started, but I'm not ready to retire yet. And so all I can do in this middle period, this midlife in general, midlife in investing, is just continue. Continue shoveling money into our 401k. Continue maxing out IRAs. Continue doing the same old thing and wait for it to finally someday be worth enough for us to take time off of work or go part-time or fully retire. And so in a way, for me, the reason to dividend invest is just to have something kind of interesting to look at and something interesting to track along the way. $700 is not a significant portion of our net worth. And so for me, I'm not worried about losing this money, but I'm not worried about it also because even if I don't get good returns here, it's not going to critically impact our overall trajectory financially. And so in a way, it's kind of like play money. In a way, it's something to do on the side, but it's also something that I've intentionally avoided learning. And that's something I need to stop doing, because my job here with you is to learn something and translate it in a way that's interesting and appealing for you to watch too. So as I learn more and more about dividend investing, and as I see what I'm doing right and wrong, I want to share that with you in the future so that you know, hey, maybe I shouldn't do what Brendan did because he had way too many finance companies, or he shouldn't have been using Robinhood in general because now Robinhood as a service is dead because they did some bad things, or whatever that looks like in the future. If you want to join me on this dividend journey in the future, then go ahead and hit subscribe so that you don't miss any future videos. And until next time, I'll see you later. And the secret comment word for today is cash, because dividends are paying us out in cash. in a way. I have everything set to drip, but, you know, it's cash for a moment there before it gets reinvested. All right, see you next time. Bye.